Hello, everybody. Welcome to yet another one of my econ streams. I am John. I am really excited to get into the topics for today's stream. And I'm really excited for anybody that's here to come hang out and watch going into Labor Day weekend, because what's more fun going into your long weekend than hanging out with me online, learning some new stuff about economics and our financial markets, right? I can't think of anything more entertaining to do than that on a Friday night. So, there's a couple things I want to get into here before we really get rolling that are more economics based. And I think that is going to kind of influence the conversation when it comes to the primary topic of this video, which is like, what are we looking for the stock market to bottom? And there's a lot of considerations, right? If I knew exactly when the stock market was going to bottom, I probably wouldn't be here streaming. I'd probably be day trading. And honestly, that's the $1 million question for literally anybody. But we can get close to estimating around when it's a good time to begin accumulating for the next bull run. Is the bottom in yet? I personally don't think so, and we will go over why in a second. So, taking a look at this tweet that I made on August 9th, right? I said, price seems to be struggling to advance near key resistance across the board. By across the board, the assets that I'm showing here are the NASDAQ, the S&P 500, the Dow Jones, and Bitcoin. Bottom might be in, but another leg lower this year feels more likely, even with a positive inflation outlook, right? So this was midway through the most recent relief rally that we saw in the stock market. If you go, right, so August 9th, is right here, right? So more than midway, right? We run into a little resistance here because of whatever happened there. And we did go for another week or so, but like the relief rally was running out of steam. And that is more or less what I was trying to warn of when I made that comment. Again, I believe this one was from August 26th. Something like that. This was less than a week ago that I said this. It said equities more or less rejected at their 200-day moving average. The relief rally is grinding to a halt. It's still my hypothesis that we have one more leg down to go. We could have more than one leg down to go, but I think that, one more big, scary leg down is probably kind of what I'm looking for. So taking a look at what I meant by this, right? This is the 200-day moving average, this purple line right here. It's the very top one because all of these other shorter term moving averages, which is the 100-day, the 50-day, the 20-day, and then I have the 8-day, more so for the purposes of short-term trading for Bitcoin. But what you're seeing here is since this bear market truly started to set in, that 200-day moving average was acting as strong resistance. They continued to act as strong resistance. So I was looking for this to kind of be the area that we got rejected. At first, I was looking here, right? Shoot this across. Okay, we got to make it over that hump first. And then I'm setting my sights to the 200-day. If we got above this, I'd set my sights right here. If we got above that level, I'd say, okay, we can actually start having conversations about like a next bull run and maybe aiming for new all-time highs. We didn't get there. We didn't even get close, right? The second of our three final bosses that we needed to face didn't work out. And as a result, we got rejected, and not just on the Dow Jones. The NASDAQ didn't even make it there, which I guess makes sense because the NASDAQ has been incredibly weak since it's mostly tech stocks, right? I mean, look, perfectly rejected at the 200-day moving average there. We're coming up to it, didn't even make it, started moving back down. S&P 500, same thing, right? Resistance at the 200-day. This actually made the strongest push above it before this bear market started to set in. But I mean, rejected to it basically down to the dollar, right? The 200-day moving average was 43.26.17, and the high for the day was 43.25.28. So it is a dollar short of being rejected at the 200-day moving average to the dollar. Bitcoin hasn't even made it close to its 200-day moving average. The 200-day moving average is actually still above $30,000, but Bitcoin did get rejected off of the 200-day moving average back in March, and it's been, blood ever since, more or less. Okay, so cool. The relief rally failed. We're moving back down. Now, again, we want to talk about conditions, macroeconomic conditions, right? Because this isn't just like average, like, stock market up and down, whatever. There's the entire macroeconomy, world economy that we have to take into consideration when we talk about when this bear market might end. So let's just take a look at what the past few months have looked for the American and global economy. So first, rents and mortgage payments have skyrocketed in a very short amount of time. And I don't think this is sustainable, right? Now, this is happening because the Federal Reserve is raising interest rates, right? And anybody that has been around for a little bit kind of knows that I have a pretty big interest in monetary economics. And right during the recession, or the COVID recession, right, the pandemic 2 years ago, we did what's referred to as a lot of quantitative easing. Or if you're on Twitter more often than not, we did a whole lot of money printer went burr, right? Started shelling out money because people were unemployed, people were scared, people were struggling to hold a job. All these different uncertainties, all these businesses closing down for the social distancing, right? Concert venues, blah, blah, blah. List goes on. Okay, cool. So what happens there then is with all of that liquidity, you eventually had to deal with inflation, right? Because what happens when you lower interest rates and make money printer go burr is that people start spending that money, right? So you have an increase in demand, just a general increase in demand because people have more money to spend, so they have more stuff to go in demand, right? That eventually causes asset prices to rise, and asset prices rising isn't a good thing if they're only rising because we printed money and we have this very hot market, right? So we got April 2020 here, and then it's been nothing but just a crazy ramp up in inflation ever since then. Okay, cool. So what does the Federal Reserve have to do? Not only do they have to turn off the money printer, but they have to start coming up with ways to suck that liquidity out of the market, right? So in order to do that, you need to curb demand, right? It's not just like, okay, we stopped printing money. It's we stopped printing money. We're trying to pull money out of the market by raising taxes, by lowering, asset prices, like risk on asset prices, by letting some of these other asset prices kind of have their way in the market, and by trying to diminish the amount of money that people want to spend in the short term, right? And again, they do this through interest rates. So now, okay, we got to make money printer stop going burr. We're going to make interest rates increase, right? And then that is going to slow down the economy. So with the increase in interest rates, we see an increase in housing prices, mortgage payments, and rents, right? Rents have skyrocketed across the board. I know for a fact that my rent went up pretty substantially in the past year. And then you take a look at just general economic activity, right? I said, okay, well, demand has decreased as a result of this as well. So you look at the Composite Purchasing Managers Index, which is an indicator of economic health on manufacturing and services within the United States. And not only is this the sharpest decline on record, with the exception of the pandemic, decline that happened across the board with stock markets and manufacturing and stuff like that, but it is actually the lowest it's been since 2008 and that short, brief COVID recession when the pandemic first set in. So let me repeat that, right? Our actual manufacturing and services industry health is not only the worst that it's been ever since we started measuring this, with the exception of the other 2 times we were in recessions since we started measuring this, but it's also the quickest that we've fallen, right? So raising these interest rates and sucking liquidity out of the economy really did have a very dramatic effect in a relatively short amount of time, right? We started raising interest rates just earlier this year. Swoopy line we, says Brandon, and you can see swoopy lines going we to the downside. Very important. And then with that, also with the war in Russia, with these increasing in interest rates, with these supply chain issues, with the slowdown in manufacturing, the holy grail of economic recessions, energy prices have been skyrocketing. And oil, and just in general energy prices, especially in Europe, because they are not as energy independent as the United States is, relatively speaking. And the result of that is a skyrocket in energy prices. And look, I don't care what sector of the economy you're in, no matter what, you are going to be affected by energy prices. It is the baseline for how we run the rest of our economy, right? And we can't have we can't have nice things in the rest of our economy or in the stock market or in Bitcoin or anything like that until we start seeing some of these things stabilize and level off. Okay, so we've established now that the macroeconomic picture is not great. So the one thing that's actually interesting is that the stock market will probably bottom a good deal before the economy bottoms. Could be by a few months, could be by a year. I can't tell you for sure. All I know is that historically, the stock market bottoms before the economy does, is because people price in their negative expectations about the economy in the stock market before those negative economic expectations become a reality. And by the time those negative economic expectations become a reality, people are already kind of looking towards what's next, what's the recovery looking like, things like that. I can't tell you what the timeline is for any of this stuff. I personally, if you want a little bit of optimism, I personally feel that we are well underway to getting some of these cool down metrics that the Federal Reserve is looking for, that we can start maybe potentially talking about not only a stock market, but an economic bottom within the next 6 months to a year. That's my guess. This might age horribly. That's kind of relatively what I'm thinking. Okay, so we've established mortgage prices are skyrocketing, economic activity and economic health is way down. Energy prices are skyrocketing. We obviously know oil prices are way up, and the stock market just recently got rejected off of the 200-day moving average on its most recent relief rally, which means we probably have more downside ahead. Cool. Oh, and look, I'm sorry I have to be snarky here, right? I've been warning about like bearish market situations for the past 7 months now, right? I literally started, most people start YouTube channels in the middle of a bull market when everybody's looking to shell out their money and stuff. And then they're trying to capitalize off of that like starry-eyed audience to try to, learn about what the next thing they should invest in and probably get ripped off on is and all that stuff. I started this YouTube channel and started talking about this stuff on like, as public as a level as possible. Literally as the bear market was just starting to set in. I've been warning of this for a minute, but the nice part is anybody that's been with me on this journey hopefully has been better informed about what these conditions look like. Cool. So, now we're going to talk about the conditions for where I think the stock market is going to reverse. So the big knockout punch on the stock market that I've been referring to over and over and over again through this, amongst two other things, right, is the United States dollar currency index. When this baby is in an uptrend, right, everything else is in a downtrend that you would like to see go up. Just stocks, crypto, all that good stuff. If this baby's in an uptrend, you're not going to see your stock portfolio do super well, right? We saw this go into an uptrend from 2018 through 2019, right? What happened to the stock market in 2018? Let's go check it out. I'm going to switch to a weekly basis just so that we can stretch these timelines. Here's 2018 in the stock market, right? Whole lot of nothing for the most part. We just started to kind of break out of this accumulation range into 2020, and then obviously COVID hit. Okay. Go back to the dollar index here. Big run up in 2015. Let's go take a look at the stock market. 2015, a whole lot of nothing. Right? And then we broke out. And then obviously you can see two massive run-ups from 2008 to 2010. Look, I'm sure we're all aware that 2008, 2010 was the Great Recession. No, the stock market was not doing great during that time. The recession was great, but the stock market wasn't. All right. So why do I talk about this? First of all, this is the most like relentless parabolic rally I think the dollar has ever had in my for sure in my lifetime. 2014 might compete with it actually. So, but like it's been nuts. It's just been relentless uptrend, right? And not only has it been a relentless uptrend, but it hasn't. It just hit a new high this week, right? So we're really still trending up here. Okay. So this is condition number one, right? The United States dollar currency index needs to enter a decline because what this is saying is it's more attractive to just hold the United States dollar than it is to be in other assets. This is measured against a basket of other currencies. It's not actually measured against equities, but the idea remains the same, right? If the United States dollar is really attractive to hold, then other assets are not as attractive to hold. And the United States dollar has been increasingly attractive to hold since May of 2021, right? The second thing that needs to happen in order for a stock market to bottom is inflation needs to start coming down. Has inflation started coming down? No. We had our first just little inkling that it might from this most recent month's inflation report, right? See how that's like flat, basically. I think I have one that shows the general inflation rate rather than the consumer price index. Bear with me here. Yep, I'm gonna take this off a logarithmic scale. Just a little easier to see what's going on here, right? Because this is actually showing like the inflation rate rather than just the consumer price index, which is what we use to measure inflation. Um, and if you look, this might mean that we topped, but not necessarily, right? I mean, we could just hang out here for a sec and then go on another move up, right? With the way energy prices have been looking, with the way housing market prices have been looking, with the way that oil prices have been looking, which I mean, look, oil might have topped. We don't know, but we also don't know that it has for sure, right? So I'm not fully convinced that we can just say, oh, we beat inflation, we won, right? Okay, so the dollar index has not stopped going up. Inflation is still increasing, right? Worst inflation that we've had since the 1970s. By the way, 1970s really bad for stock or for investments, right? It was not good for the stock market. And then the other thing is that the Federal Reserve needs to stop raising interest rates, right? Which and I've said this over and over again. This is probably the 10th stream that I've gone over these three conditions: the dollar index, inflation, interest rates, right? Now, again, we don't necessarily need to have the interest rates start going down for the stock market to bottom and start going back up. We just need for them to stop raising them, which I think we might be getting close to that phase. Maybe. I don't want to say for sure. I think that we need to see the recessionary pressures probably be, around the same that they currently are, or maybe get worse. And I think we need to see inflation actually legitimately enter a downtrend in order for the Fed to think, okay, maybe we can stop raising interest rates. Personally, if I were a betting man, I'd say they do like another like 50 basis point increase in this September meeting, and then they hold constant for a while. They hold constant for as long as they possibly can. And personally, I want them to hold them constant. Why? Because I don't want us to feel recessionary pressures, lower interest rates, start making money printer go burr again, and then we have to deal with this inflation problem all over again. I'd much, much, much prefer that we put this inflation issue to bed, we make sure that it's gone, and then hopefully we can have another sustained rally in the stock market. That might take until 2024, 2025 until that happens. Like that is very plausible, and I want you to kind of be buckled in for that. Okay? So this situation here is going to heavily dictate what stocks do. Now, if this starts to curl over eventually, like, look, what happened last time this curled over, right? The stock market did really well for a 2-year phase because we made money printer go burr and people were looking for a place to put that money in investments, right? So we'll see what happens here. But we keep checking in on these different metrics, right? Like I said, this is probably the 10th time I've gone through these three different metrics. And the thing is that while none of them have turned around yet, I would say we are much closer to that phase than we were when I first started talking about them. Because the Federal Reserve is starting to see what it wants to see out of these interest rate raising efforts, right? People's eagerness to spend has 100% slowed down. Asset prices are cooling off, right? People value things like energy prices and commodities a lot more than they value Dogecoin. Thank God. Um, Things like that, right? And these are not fun times for the market or the economy. They can get really brutal, right? And people also will say, like, this is just something I hear a lot lately. John, I can't say that I think we're in a recession yet because unemployment has not gone down. That is true. We go Fred unemployment rate. Shift the scale, right? Unemployment has just kind of chilled. It actually looks great. But one thing that I want everybody to remember is that unemployment is a lagging indicator. What do I mean by that? Well, if you own a business and your business has been outpacing your financial estimates for what you need to be a profitable business for 12 months, not only are you feeling pretty good, but you might be reinvesting those additional profits back into the business. You might be building yourself a nice savings cushion. Um, you might be looking to hire on new people to help expand your business, right? Et cetera, et cetera. You've had very consistent financial performance for a year, and now you're looking to reap those profits and take them into some other part of the business that feels growth and expansion. Cool. Then on month 13, you miss your estimates for the first time in 13 months. Whatever, right? You have the savings, you have the profits, yada yada yada, right? It's that first month that you come in underneath your forecast, you're not going to sound the alarms, fire your workforce and shut down your business, right? But with each additional month that you start missing your revenue goals, you start to become increasingly more concerned. And then eventually, maybe you're 8 months in of missing your revenue goals and you can't put new profits into savings. You can't expand your business. You can't hire new people. In fact, you actually have to lay people off, right? Now, that story that I just said there, right? Why hasn't an unemployment rate gone down yet? Because we're 2 quarters into a recession, right? We've only been seeing this decline for 6 months. And right now, businesses across the board are trying to weather the storm. They're trying to figure out, okay, what can we do to, sustain growth so that we don't miss earnings, so that we hit our revenue goals? What new things can we invest into the business to grow the business, to try to beat out these recessionary pressures? And if those businesses fail in that goal, which it's more likely that they will fail in that goal than not, just because the entire macroeconomic picture doesn't look great, it's at that point that they will start to look to lay people off. It's not that, first of all, businesses don't like laying people off. And second of all, it's not the first thing they jump to because it's messy, right? It's super messy. They'd rather look to cut costs. They'd rather look to make the business more profitable in other ways. They might look to invest things into the business to try to curb those recessionary pressures. So say, John, we're not in a recession because unemployment is low. I can't buy that argument because, again, and I guess I shouldn't have exited out of this, but it's all good. There we go. Let me zoom in. Housing payments are the most expensive that they've ever been in about a decade since the 2008 housing market collapse. The overall health of our manufacturing and services industries is the worst that it's been, with the exception of 2008 and the original pandemic drop. And it is the quickest that we've gotten to this level of dire poor metrics, right? And then energy prices are skyrocketing. All of those sound like a recession to me, right? They all sound recessionary. So, John, why has an employment rate happen? It's because businesses are trying to weather the storm to the best of their ability, but you can only do that for so long until you have to look at cutting costs in areas that aren't just, general business costs, but employment, right? So, employment's a lagging indicator. And I'm not trying to scare anybody and stuff like that. I don't really know how bad this recession is going to get, but the fact of the matter is we are in one, and businesses that are not in a very financially sound place are going to feel pressure there naturally. Also, if you're new to the stream, or if you're not new to the stream and you have any questions whatsoever, please ask them. I use a lot of jargon. I apologize. I'm doing my best to be, as clear and simple as possible as I, kind of get on my tangents here. And I also want you to, go on my YouTube channel, and I'm starting a series that goes through definitions and the very basics of some of these things that I do, right? So I did one on technical analysis for, all these charts that I look at, and what are the things that I'm looking at in order to understand what these charts are actually telling me. Sometime in the next week or two, I'm going to do an intro to like economics, actually talk about basic supply and demand functions, the economic way of thinking, stuff like that. And I want to do one just for general finance, right? Like, what is an asset? What is leverage? What is a derivative? What is an ETF? Like all of that kind of stuff that just kind of helps, get everybody used to all the silly jargon that I'm using while I'm going through these videos, so that you guys can follow my line of thinking with all of this stuff. Another thing that I want to take a look at, though, that I do think is interesting is commodities might have actually topped. And I'm really interested in that because, again, like during a recession, we're going to see commodities increase. It's going to be more expensive to just do like basic stuff. So if this actually starts to fall off and, starts to revert back to its average, that would be phenomenal for just, general economic outlook and recessionary pressures. Okay, so just to wrap up before Kyle, you're the man. I appreciate you. Just to wrap up before I start kind of moving on to some of the research that I'm doing and some of the fun stuff there. Once again, fully recapping, the United States dollar currency index needs to start decreasing for us to feel like we've bottomed in our stock market and risk on assets, right? Additionally, inflation needs to start coming down. It has not yet. And additionally, the Federal Reserve needs to stop raising interest rates. It has not yet. Okay. These are the three metrics we're looking at to maybe consider whether or not the stock market has bottomed. And while, again, I think we are closer than not to those things happening, especially like, versus a few months ago when we were really just starting to see the ramp up in all of these things, I still think there's still quite a bit of time before we actually see these metrics start to go in the direction that we want. Then the nice part is that once we see those things go down, there's going to be a nice accumulation phase to follow, right? The stock market and, all of these other assets that we like aren't just going to go straight to new all-time highs. There's no way in heck that's happening in this environment. They're going to slowly, let's just say, okay, we have this final capitulation down that I think we're going to get. Who knows if we actually do? This is just my speculation, is, might look something like this, right? And then there's going to be an accumulation phase where we just go sideways forever. And this is a wonderful area to buy when those situations happen. And then from there, we'll slowly but surely start to build confidence for a new bull market, right? You don't need to rush into the market by any means once we actually do see the United States dollar currency index start to decline. You don't need to rush into the market right away once we do see the Federal Reserve is content with where the interest rate's currently at. You don't need to rush into the stock market just because inflation's starting to come down, right? You can just slowly work your way back into the market, knowing that you're getting a good average price so that you're primed for whenever the next bull run is. This is not financial advice. Okay, cool. So that's kind of all I wanted to say. I guess really quick look at the crypto market, really quick look, because it's just doing the same stuff that all of the other markets are looking for. I'm expecting one more move down, just like I am in the stock market. That move for me is between $13,000 and $15,000. So that's where I'm kind of looking. We'll see if we actually do go that low. Maybe I'm wrong. Maybe the bottom's already in and I'm just pessimistic. That's also equally as plausible across the board here. So just something to be cognizant of. Cool. All right. I wanted to selfishly also take just the rest of the stream to talk about some of the research that I am working on for my last semester at George Mason University. So the first one, which is the most complete paper, as in the other ones are just ideas and outlines at this point, is an analysis of cryptocurrency use under economic stress. So what I did, let me skip down to the bibliography here, annotated, is I took a data set of 148 countries' inflation rates, 148 countries' gross domestic product, which means their economic output, and their general rates of economic freedom, their inflation rates, and then their cryptocurrency adoption metrics, right? And I took all of these things, and my hypothesis for this paper was suggesting that countries that have high levels of economic stress, be institutional failure, high levels of inflation, low levels of economic freedom, low levels of economic output, use cryptocurrency as money, as peer-to-peer money, at higher rates than developed nations that do not have those problems. And then additionally, what would strengthen these results of my hypothesis is that with that general cryptocurrency adoption, which means not using it as money, right? Using it as an investment, using it for NFTs, using it because Dogecoin is a funny name for something you invested in. Those things shouldn't correlate as strongly as the actual monetary peer-to-peer use, right? So that's what I'm looking for here, is that countries that, have it worse off are using cryptocurrency as money at higher rates that are countries that are better off, but those correlations don't exist as strongly in general cryptocurrency adoption, right? So this is the most complete paper that I have so far. I'm hoping to get it out sometime in 2023, but just taking a look at these regressions here, this is, by the way, Venezuela, Zimbabwe, and I think Argentina are the three outliers that have really high inflation. But countries, pretty much the data overall across the board. Hi, Lena. Countries overall across the board actually do use cryptocurrency as money at higher rates if they are under different forms of economic stress. This was measuring it against inflation. You can see a very strong p-value there. And then I did the exact same thing, but I excluded the hyperinflation outliers. You still had some very strong results. You can take a look at then overall crypto adoption, and the results aren't as strong, right? And this is what I saw measuring it against inflation. This is what I saw measuring it against GDP, which I'm trying to scroll down to. Sorry, I did economic freedom, right? So lower levels of economic freedom suggested higher levels of using it as money, using cryptocurrency as money. And then I did it with GDP and found a lot of the same results, right? So hopefully I'll have this again published somewhere in early 2023, but just, something to take a look at. I'm very thousand eye view on this because it gets very academic and nerdy, but I thought that was interesting. And then the other things that I'll be doing is taking a look at how our current financial regulators, which, that's the FCC, or sorry, the SEC, the Futures and Commodities Commission, the IRS. There's a lot of different regulation in our financial markets, and if they affect corporate governance participation rates, and then contrasting that with cryptocurrency governance, where there isn't nearly as much regulation, to see if our financial regulation actually has an effect on how much people show up to do proxy votes and things like that. That's the other piece that I'm working on. Another one that I don't have quite as much say on is just looking at the emergence of the Federal Reserve and other central banking institutions and what that did to the gold standard in the early 1900s. Then the fourth thing, shout out to all my Michigan homies, is I'm going to be assessing what made Detroit the arsenal of democracy during World War II. Why we were so perfectly suited to become the manufacturing hub that really helped America get all of the equipment and things necessary in order to sustain that war effort coming out of the Great Depression, right? So those are kind of the four pieces of research that I'm going to be looking at, and then I'm probably just going to be finishing each of those up through early 2023. So I'm really excited about that. I'm incredibly excited about how this paper came out, just because the findings were just so perfectly in line with what I speculated on, the hypothesis. I'm really excited for this to actually, get fully finished up through the semester and then go through a peer review process where, other people who are a lot smarter than me and a lot better at this kind of research than I am can critique me and, tell me how I can improve upon the paper. But yeah, so I think that I'm gonna wrap it up for today. Keep it kind of short and sweet. Usually these streams go over an hour, but like it's a Friday evening going into Labor Day weekend. So again, I think people's patience for this type of content probably only goes so far. But I hope that all of you have a safe Labor Day weekend. I hope that you are also not, betting the family farm on the stock market bottoming anytime soon, and that you didn't take a leveraged long on this most recent relief rally. That's how I'm wishing you well to end this stream. I hope you have a wonderful weekend, and I will see you guys next time.